Welcome to Inventory Management and Reporting in Accounting Systems. In 5 minutes you'll learn how to set up items, record transactions, and read key reports. Agenda: 1. Set up inventory and non-inventory items. 2. Record purchases, sales, and stock adjustments. 3. Interpret valuation and turnover reports to drive decisions. Let's dive in. Inventory items are products tracked in stock. Non-inventory items are services or supplies not tracked in stock. Steps to add an inventory item: go to Products or Services, select New, choose Inventory Item, then enter the name and SKU. Add sales info and purchase info, set the initial quantity and the inventory asset account. For non-inventory, choose Non-inventory Item or Service. Enter the relevant info like name and the income account. Why distinguish them? Accurate reporting and better tracking. It prevents stock misstatements and helps cost allocation. Purchases increase the inventory asset account. Journal entry: debit inventory. Credit accounts payable or cash. Vendor bill records a future payment. Expense is an immediate deduction. For inventory, use purchase orders and vendor bills. Avoid expense entries. Receiving increases on hand. The bill books the liability. Sales recognize revenue and reduce stock. Debit accounts receivable or cash. Credit sales. Then debit cost of goods sold and credit inventory. Each sale reduces quantity on hand automatically in good systems. Two sides: revenue up, inventory down. COGS hits the income statement. Match sales, COGS, and cash collection for clean reporting. When physical count differs from system quantity, adjust. Use the inventory adjustment tool to true up quantities and value. Entry example: debit or credit inventory adjustment, offset inventory. Reasons: theft, damage, obsolescence, or count errors. Modern software auto-updates after each purchase or sale. Set reorder points to trigger alerts before stockouts. This prevents lost sales and last-minute scrambling. Pro tip: review reorder reports weekly. Inventory valuation shows quantity, on hand, total value, and unit cost. Use it to ensure balance sheet accuracy. Inventory turnover equals COGS divided by average inventory. High turnover means fast sales and efficient inventory. Low turnover signals overstocking or slow movers. Use reports to adjust pricing, optimize reorders, and manage working capital. Inventory aging shows how long items sit, spot, slow, or obsolete stock. Accurate inventory drives accurate COGS and better gross profit. Key takeaways: set up items correctly, record purchases and sales properly, then use valuation and turnover reports to make smart decisions. Ready to practice? Open your software and walk through each step today. Recap: categorize items as inventory or non-inventory. Add name, SKU, sales and purchase info, initial quantity, and asset account. For purchases, bill or PO to increase inventory. No expense entries. For sales, debit AR or cash, credit sales, then debit COGS and credit inventory. Use adjustments for theft, damage, obsolescence, or discrepancies. Set reorder points to prevent stockouts. Read valuation, turnover, and aging reports to guide decisions. Accurate data improves COGS, pricing, and gross profit. Subscribe for more accounting labs, download the practice checklist, and comment your questions. Before you go, subscribe, download the checklist, and comment your questions. Visit the link in the description for more labs.